What if the Colorado housing market isn't just slowing down, but quietly setting up for something much bigger? Because right now, across the state, the data is starting to tell a very different story than what most people expect. And if you're only looking at surface-level headlines, you might completely miss what's actually happening underneath. Because inventory is rising, buyers are pulling back, homes are sitting longer, and in some areas, prices are already beginning to soften. And when all of those things happen at the same time, it usually doesn't end with stability. It usually leads to a reset. And what makes this moment different from past slowdowns is how many of these signals are appearing all at once because historically housing markets tend to shift gradually. But when multiple pressure points hit simultaneously, the speed and scale of that shift can increase dramatically. And according to recent reporting, Colorado is entering what analysts are calling a housing reset phase going into 2025 and 2026. And that word reset matters because it reflects a transition away from the aggressive appreciation that defined the pandemic era toward a market where pricing power is no longer firmly in the hands of sellers. And at the same time, the Colorado Association of Realtors described 2025 as a frustrating year for both buyers and sellers, which is one of the clearest early indicators of a market losing momentum. Because when buyers feel priced out and sellers feel like they can't get the offers they expect, it creates a stalemate that slows transactions and reduces liquidity. And when liquidity drops, it becomes harder for the market to sustain elevated prices. And what's even more important is that this isn't happening in just one isolated market. It's happening across multiple regions simultaneously, which suggests a broader statewide adjustment rather than a localized correction. And when you zoom out even further and consider the national backdrop of elevated interest rates, tighter lending conditions, and growing economic uncertainty, it becomes even clearer that the conditions supporting the housing boom are no longer as strong as they once were. And this is where psychology begins to play a critical role. Because housing markets are not driven purely by numbers. They are driven by expectations. And once expectations shift from believing prices will always rise to questioning whether they might fall, behavior changes quickly. Buyers become cautious. Sellers become more flexible and the entire market dynamic begins to shift. And in today's breakdown, we're going to walk through 10 Colorado housing markets where these warning signs are becoming impossible to ignore. And more importantly, explain why these areas could be the most vulnerable if current trends continue. Number 1. Denver. Denver has long been the centerpiece of Colorado's housing market growth, serving as both an economic hub and a magnet for migration, which created a powerful combination of demand drivers that pushed prices higher year after year. But what makes Denver so important right now is not just its size, but its influence, because when Denver shifts, it tends to set the tone for the entire state. And over the past few years, Denver experienced a surge in demand, fueled by low interest rates, strong job growth, and an influx of buyers relocating from higher-cost areas, which created intense competition, limited inventory, and rapid price appreciation. But now, many of those conditions are reversing because migration has slowed compared to pandemic highs, meaning fewer new buyers are entering the market, while at the same time, affordability has deteriorated significantly, with higher mortgage rates dramatically increasing monthly payments, which reduces purchasing power across the board. And this combination is creating a situation where demand is no longer keeping pace with supply, because inventory levels are rising as more homeowners list their properties, either to cash out or because they can no longer justify holding onto assets in a shifting market. And when inventory rises faster than demand, homes begin to sit longer, which is exactly what we're seeing in Denver, where days on market are increasing and price reductions are becoming more common. And this shift from immediate sales to extended listing times is critical because it changes seller behavior, forcing them to compete on pricing and incentives rather than relying on bidding wars. And speaking of bidding wars, those have become far less frequent, which removes one of the key mechanisms that previously drove prices higher. And another important factor is investor activity, because investors played a major role in Denver's growth by purchasing properties for rental income or appreciation. But now, with higher borrowing costs and softer rent growth, many investors are pulling back, which removes a layer of demand that once supported higher valuations. And when you combine all of these factors, slowing migration, declining affordability, rising inventory, reduced investor activity, and shifting buyer psychology. You get a market that is no longer in expansion mode, but is instead transitioning into a phase of adjustment where prices may not collapse overnight, but are increasingly vulnerable to downward pressure, especially if current conditions persist. Number 2. Boulder. Boulder represents one of the most unique housing markets in Colorado because of its limited supply, high demand, and premium pricing, which historically allowed it to outperform many other regions. But that same premium positioning also makes it more sensitive to changes in demand at higher price points. Because when home values reach extreme levels, the number of qualified buyers naturally becomes smaller and more dependent on financial conditions such as interest rates and income stability. And right now, those conditions are becoming less favorable because higher mortgage rates significantly impact affordability, even for high-income households, which reduces the pool of buyers who can comfortably enter the market without stretching their finances. And this is where luxury markets like Boulder begin to show early signs of weakness because when demand slows even slightly in a market with a limited buyer pool, the effects can be amplified, leading to longer listing times, increased price adjustments, and a gradual shift in negotiating power toward buyers. And another important dynamic to consider is that luxury buyers often have more flexibility in their purchasing decisions, meaning they can choose to wait if they believe prices may decline, which further reduces immediate demand and increases inventory pressure. And we are already beginning to see these patterns emerge, with properties staying on the market longer and sellers becoming more willing to adjust pricing or offer concessions to attract interest. And once these behaviors become more widespread, they can influence broader market sentiment by signaling that the period of consistent appreciation may be ending. And when sentiment shifts at the top of the market, it often filters down into mid-range and entry-level segments, creating a ripple effect that extends beyond the luxury category. And because Boulder sits at the higher end of the pricing spectrum, its performance can serve as an early indicator of broader market trends, making it one of the most important areas to watch as conditions continue to evolve. Number 3. Colorado Springs. Colorado Springs has historically benefited from its reputation as a more affordable alternative to Denver, attracting buyers who were priced out of larger metro areas and seeking lower-cost housing options. But over the past several years, rapid price appreciation combined with rising interest rates has significantly eroded that affordability advantage, creating a new set of challenges for the market. Because as prices increase faster than incomes, the gap between what buyers can afford and what sellers are asking continues to widen. And this gap becomes even more pronounced when mortgage rates remain elevated because higher rates increase monthly payments and reduce the maximum loan amounts that buyers can qualify for, which effectively shrinks the pool of eligible buyers. And as a result, demand begins to slow. Not because there is no interest in the market, but because fewer buyers are financially capable of participating at current price levels. And this slowdown in demand coincides with an increase in inventory, as more homeowners list their properties, either to take advantage of prior price gains or because they anticipate further changes in the market. And when inventory rises while demand weakens, the balance shifts toward buyers, creating downward pressure on prices and increasing the likelihood of price adjustments, particularly in areas that experience the most rapid growth. And another factor to consider is that markets like Colorado Springs are often more sensitive to shifts in affordability because a significant portion of their demand comes from buyers who are already budget-constrained, meaning even small increases in costs can have a disproportionate impact on market activity. And as these dynamics continue to play out, Colorado Springs is becoming a key example of how quickly a market can transition from growth driven by affordability to vulnerability driven by the loss of that same advantage. Number 4. Fort Collins. Fort Collins experienced a surge in demand during the pandemic as changing lifestyle preferences and remote work opportunities encouraged buyers to seek out markets that offered a balance of affordability, quality of life, and proximity to larger economic centers. But as those conditions begin to normalize, the market is now entering a phase where demand is no longer being artificially elevated by external factors. And this normalization is having a noticeable impact on market dynamics. Because when demand decreases even slightly in a market that experienced rapid appreciation, the effects can be magnified, leading to longer listing times, reduced competition among buyers, and a gradual shift in pricing power towards sellers being replaced by buyers. And one of the key indicators of this transition is the increase in days on market, which reflects a slowdown in transaction speed and signals that homes are no longer being absorbed as quickly as they once were. And this change in pace forces sellers to adjust expectations, either by reducing prices, offering concessions, or waiting longer for offers, which in turn influences overall market sentiment and can lead to a broader adjustment in pricing trends over time. And another important aspect of Fort Collins is its reliance on lifestyle-driven demand, which can be more volatile than purely economic demand, because lifestyle preferences can change quickly in response to broader conditions, such as economic uncertainty or shifts in work patterns. And as these factors continue to evolve, Fort Collins is likely to experience a period of recalibration where prices and demand find a new equilibrium that reflects current conditions rather than the unique circumstances that drove the previous surge. Number 5. Aurora. Aurora has become one of the most closely watched housing markets in Colorado, not because it is the most expensive or the fastest growing, but because it sits right in the middle of multiple competing forces, which makes it a perfect example of what happens when a market begins to lose balance. And recent reports describing Aurora as a frustrated market are extremely telling, because frustration on both sides of the transaction is one of the clearest indicators that momentum is breaking down, as buyers struggle with affordability and financing conditions while sellers struggle to achieve the prices they expected based on past market performance. And when both sides are dissatisfied, transactions begin to slow, which reduces overall market activity and creates a ripple effect throughout the system. Because fewer transactions mean less price discovery and less confidence in where the market is headed, and that uncertainty causes buyers to hesitate and sellers to either hold firm or adjust pricing depending on their individual circumstances. And in Aurora, we are already seeing several key warning signs, including rising inventory levels, which indicate that more sellers are entering the market at a time when demand is weakening, as well as longer days on market, which suggests that homes are not being absorbed as quickly as before. And another important factor is the increase in price sensitivity among buyers, who are now more willing to walk away or negotiate rather than compete aggressively, which changes the entire dynamic of the market from one driven by urgency to one driven by caution. And as this shift continues, Aurora could experience increased price volatility, particularly if economic conditions remain uncertain or if interest rates stay elevated, because in markets that are already under pressure, even small changes in demand can have amplified effects on pricing and activity. Number 6. Lakewood. Suburban markets like Lakewood saw a massive surge in demand during the pandemic as buyers prioritized space flexibility and lifestyle changes over proximity to urban centers, which created a wave of demand that pushed prices higher and reduced available inventory. But now those trends are beginning to reverse, as the factors that drove them evolve because remote work is no longer expanding at the same pace. And many employers are implementing hybrid or in-person requirements, which reduces the need for buyers to move further away from city centers. And at the same time, affordability constraints are becoming more pronounced as higher interest rates increase borrowing costs and limit purchasing power, which makes it more difficult for buyers to justify higher-priced suburban homes. And as demand begins to cool, inventory starts to build, which shifts the balance of power from sellers to buyers and leads to increased negotiation, reduced bidding activity, and greater price sensitivity. And suburban markets that experienced rapid growth are particularly vulnerable to this type of shift, because their price increases were often driven by temporary conditions rather than long-term fundamentals. And when those conditions change, the market can adjust more quickly than expected. And in Lakewood, we are beginning to see these patterns emerge, with more listings staying active for longer periods and sellers becoming more flexible on pricing, which indicates a transition toward a more balanced or even buyer-leaning market environment. Number 7. Greeley's. Greeley's housing market has been largely defined by its relative affordability, which attracted first-time buyers and those seeking lower-cost alternatives to larger metro areas. But even in a market like Greeley, the rapid pace of price increases over the past several years has begun to outstrip income growth, creating a widening gap between what buyers can afford and what sellers are asking. And this imbalance is one of the most important indicators of potential market stress, because when affordability declines, demand weakens particularly among entry-level buyers who are more sensitive to changes in interest rates and monthly payment requirements. And as mortgage rates remain elevated, the number of buyers who can qualify for loans decreases, which reduces overall demand and leads to longer selling times and slower price growth. And another key factor is that entry-level markets rely heavily on consistent inflows of new buyers to sustain activity. And when that inflow slows, the effects can be felt quickly as inventory builds, and sellers are forced to adjust pricing to attract interest. And this dynamic creates a feedback loop where declining demand leads to longer listing times, which leads to price reductions, which in turn influences buyer expectations and encourages further hesitation. And as this process continues, Greeley may experience a gradual but noticeable shift toward lower price growth or even price declines, depending on how broader economic conditions evolve. Section 8. Pueblo. Affordability. Pressures. Building. Number 8. Pueblo. Pueblo has long been considered one of the more affordable housing markets in Colorado, which has historically provided a degree of insulation from the volatility seen in higher-priced areas. But affordability alone is not enough to guarantee stability, especially in an environment where overall costs are rising. Because buyers are not just evaluating home prices, they are also considering total cost of ownership, which includes insurance, utilities, property taxes, and general living expenses. And as these costs increase, they reduce the effective affordability of even lower-priced homes, which can lead to a decline in demand, particularly among budget-conscious buyers. And in addition, economic conditions play a significant role in markets like Pueblo, where local job growth and income levels may not be as strong as in larger metro areas, making the market more sensitive to broader economic trends. And as demand begins to soften, inventory can build more quickly, because there are fewer buyers available to absorb new listings, which leads to longer selling times and increased pressure on sellers to adjust pricing. And while Pueblo may not experience the same level of volatility as higher-priced markets, it is still vulnerable to gradual declines if affordability continues to deteriorate and demand remains subdued. Number 9. Grand Junction. Grand Junction experienced a surge in demand during the pandemic as buyers sought out smaller markets with lower density and different lifestyle opportunities, which led to rapid price increases and a tightening of inventory. But as those migration trends begin to normalize, the market is now entering a phase where demand is returning to more typical levels. And when demand decreases after a period of rapid growth, prices often adjust downward as the market rebalances. And this rebalancing process can be particularly noticeable in markets that experience significant gains during unusual conditions, because those gains are not always supported by long-term fundamentals, and as a result they may be partially reversed as conditions stabilize. And in Grand Junction, we are beginning to see signs of this shift with slower transaction activity, longer days on market, and a more cautious approach from buyers who are no longer competing aggressively for available properties. And as inventory continues to rise and demand remains moderate, the market may experience further adjustments as it finds a new equilibrium that reflects current economic realities rather than the unique circumstances of the pandemic period. Number 10. Centennial. Centennial and surrounding metro areas are closely linked to the performance of Denver's housing market, which means that changes in Denver often have a direct impact on these areas. And as Denver begins to slow, Centennial is showing many of the same early warning signs, including rising inventory, longer days on market, and increased price reductions, which indicate a shift in market dynamics. And because these markets are interconnected, the factors affecting Denver, such as affordability constraints, reduced demand, and changing buyer behavior, are also influencing Centennial, creating a similar environment where sellers face more competition and buyers have greater leverage in negotiations. And this interconnectedness can amplify the effects of a slowdown, because as one market weakens, it can influence neighboring areas through changes in pricing expectations and buyer sentiment. And as a result, Centennial may experience a continued softening of conditions if the broader metro area remains under pressure. When you step back and look at all of these markets together, a clear pattern begins to emerge. This is not an isolated issue affecting just one or two cities, but rather a combination of factors unfolding across the entire state, including rising inventory, elevated mortgage rates, declining affordability, and shifting buyer psychology all occurring at the same time. And what makes this particularly important is how these factors interact with each other, because rising inventory increases competition among sellers, which puts downward pressure on prices while high mortgage rates reduce buyer purchasing power, which decreases demand. And when demand decreases, buyers become more selective and less willing to compete, which further reduces upward pressure on prices. And perhaps the most important factor in all of this is psychology, because once buyers begin to believe that prices may fall, they are more likely to delay purchasing decisions, which creates a feedback loop, where reduced demand leads to longer listing times, which leads to price reductions, which reinforces the perception that prices are declining. And this cycle can accelerate the shift from a stable market to one experiencing a more significant correction. Before you click off, I want you to really think about what we just broke down, because the next 12 to 18 months in the housing market could define where the biggest opportunities are created and where the biggest mistakes are made, and the reality is most people won't recognize what's happening until it's already too late, because they wait for headlines, they wait for confirmation, they wait for everyone else to tell them what's going on. And by the time that happens, the market has already moved, and the opportunity is either gone or much smaller than it once was. So if you want to stay ahead of what's happening, not just in Colorado but across the entire housing market, you need to be paying attention right now. You need to be watching the data. You need to be understanding the trends, and most importantly, you need to be thinking ahead of where things are going, not where they've already been. So if you found this helpful, hit that like button so more people can see this, subscribe if you haven't already, and turn on notifications because we're going to keep tracking this step by step as it unfolds. And I want to hear from you. What are you seeing in your area? Right now, are homes still selling fast? Are prices still holding up, or are things starting to shift? Because what's happening here might not just be a local story. It might be the beginning of something much bigger.